Bitcoin, crypto, Satoshi, blockchain. What the heck does it all mean? If you're just starting to learn about Bitcoin and cryptocurrency, you're in the right place. Welcome to the video that will take you from Bitcoin dummy to Bitcoin expert. You're probably familiar with the concept of Bitcoin and cryptocurrency just from watching and reading mainstream news. Bitcoin has been a hot topic and has been extremely controversial in terms of debate around if it's actually worth anything at all. However, once you truly understand how money works and the problems that Bitcoin and various cryptocurrencies aim to solve, the value will become obvious. You guys are definitely in for a treat today. We'll be covering everything you need to know about Bitcoin and the basics of cryptocurrency in plain English. And don't forget to subscribe so you don't miss any of my videos. And share with a friend who's also learning about cryptocurrency. But before we dive into Bitcoin, let's baseline and take a look at exactly what money is and the problem that Bitcoin solves. Everyone loves money. At its core, money simply represents value, and money has come in many forms throughout history depending on what was valuable at that time. In the past, you might trade me some rare shells for a dog to herd your livestock. These shells represented money, and when I traded you my dog, I also believed that these shells would be valuable in the future for another trade. See, in order for anything to have value, the person receiving it must believe that it will continue to stay valuable long enough for them to benefit from it. Today's concept of paper money and trusting a bank is actually relatively new. Now our money doesn't jiggle jiggle, it folds. That was funny, right? Anyways, in the past we've always relied around carrying gold or other valuables to trade with. And for obvious reasons, this became very cumbersome, which allowed banks and governments to offer a smarter way for commerce. Essentially, you would take your gold bar worth $100 to the bank, which would trade you pieces of paper equivalent to that $100. As you can imagine, pieces of paper are a lot easier to carry around than gold. And if you needed your gold back, you could simply trade in your pieces of paper for gold from the bank. Eventually, we stopped using gold completely and relied on paper trading. Nowadays, your paper bills aren't even backed by gold. They're simply backed by your government's promise of value. This is how fiat money as we know was created. Just like we assign value to shells or gold, we now assign a value to paper money. As time went on, we moved to use digital money. Unless you want to be that old lady in the checkout line digging through a coin purse, most of us just tap and go. We use credit cards, wire transfers, PayPal, and, well, you get the point. Now, herein lies a huge problem. Banks keep ledgers on computers of who owns what and how much. We trust the government and banks to keep accurate records of this, but what's to stop someone from copying a file that represents $1 and giving someone $1 million? This is a massive issue called the double spend problem. Throughout recent years, there have been attempts to create digital currencies to solve the double spend problem, but none have been successful without having a central authority in the loop. Having a central authority like a bank or government that controls your cash causes a load of issues. The first issue is obvious. You no longer control your money like you used to. A bank or government does. And the second issue is that there's no limit to the amount of fiat that can be printed. The government can print as much as it wants, which dilutes the value over time. Your money is worth less and less as more is printed over the years. Not only that, but when you give all of your monetary value to the government, you give them unlimited power. This leads to corruption, money mismanagement, and control over your livelihood. With so much corruption in the world, who can save us? In 2008, a mysterious hero by the name of Satoshi Nakamoto published an online document that introduced the idea of a decentralized currency called Bitcoin. This document claimed to create a digital currency that solved the double spend problem without the need for a central bank or government. It was exactly the answer we'd been looking for, but was it too good to be true? Here's how it works. Remember that bank ledger we talked about earlier? That ledger is private, which means only the bank can see who owns what. The difference with Bitcoin is that the ledger is completely transparent. No central authority owns it. You or I can go into that ledger and see all the transactions happening along with account balances. The only caveat is that Bitcoin's ledger is anonymous, so I won't be able to identify who is making those transactions or who owns those account balances. No government, bank, or bad actor could control the system, the supply, seize assets from people that hold their own Bitcoin, or create more Bitcoin. There can be no one entity to decide who can create accounts and who cannot. All the while, Bitcoin remains anonymous. Names, social security numbers, or IDs are not linked to accounts. And because of this, you can see why it's a bit controversial. This was the introduction of a new frontier for decentralized technology. All right, stick with me here. Here's exactly how Bitcoin works without getting too technical. The transactions you make with Bitcoin, whether you purchase products or services with Bitcoin or simply send some to a friend, are processed by a network of computers around the world, and not your local bank. Right when a Bitcoin transaction happens, the network will record the sender and receiver's Bitcoin addresses, along with the exact amount that was transferred, and records that information on an online public ledger called the blockchain. Every transaction on the blockchain is encrypted by multiple computers on the network, as well as verified by multiple points on the network. This is the technology that solves the double spend problem we discussed earlier. The verification process makes it pretty much impossible to counterfeit a Bitcoin transaction, unlike traditional banking transactions. So, who exactly is in charge of completing these transaction verifications? Well, I'm glad you asked. The verifications are done through what we call Bitcoin miners. And no, these are not literal people in caves mining for Bitcoin. A Bitcoin miner is simply a computer or mining device that connects to the Bitcoin network. An individual or organization may own these mining devices. The software that these computers connect to groups the transactions that occur on the network as blocks. The block of transactions can only be accepted by this network of computers if it's hashed correctly. Checking the hash is an extremely time-consuming process that involves these computers solving complex mathematical problems. Obviously, there has to be some sort of incentive for individuals to want to participate in this network. Not only is a powerful enough computer or mining device expensive, but the energy required to run the software is expensive as well. So, the incentive is this. Once the computer processes the block of transactions, the block is added to the blockchain and the system produces a new Bitcoin that is sent directly to the Bitcoin wallet of the user. Essentially, in exchange for the processing power to verify transactions, you get paid in Bitcoin in return. Sounds pretty good, right? Unfortunately, it's a bit complicated how this works, and most people are not getting rich from mining Bitcoin nowadays. Years ago, you could use a spare laptop to mine Bitcoin and generate a decent return. But now it takes a ton of computer processing power to generate a decent amount of Bitcoin. This is because as more and more people have joined the network over the years, the difficulty of earning Bitcoin has increased over time. Because the difficulty is so high, there are literally Bitcoin farms throughout the world that are essentially warehouses of supercomputers with the sole purpose of Bitcoin mining. If you're interested in mining, I recommend checking out some other cryptocurrencies that may have a higher return. And if you guys want me to create a video on this, let me know in the comments. By February 2140, all of the available Bitcoin will be mined. This will equate to 21 million Bitcoins circulating in the economy, and no new Bitcoin will be released into the market. Because of this, supporters of Bitcoin believe that it could provide a sustainable hedge against inflation of fiat currencies, like the US dollar. Because Bitcoin is a scarce resource, it's also been projected that Bitcoin will continue to increase in price until 2140, with some experts predicting that it could reach $100,000 per Bitcoin. Now, before you guys go out and take out a second mortgage to buy Bitcoin, keep in mind that it's an extremely volatile currency. Traders have been able to make a lot of money on Bitcoin, but people have also lost a lot of money. I'm currently dollar cost averaging in both Bitcoin and Ethereum at about a 50-50 split. So, what do you think? Is Bitcoin and cryptocurrency the future of money, and will it eventually replace fiat? Let me know your thoughts in the comments, and I'll see you guys on the next video.